You have been lied to about the stock market your entire life. Every financial advisor, every investing guru, every news anchor cheerleading the latest market highs has told you the same story. The stock market is a fair place where anyone can build wealth. Buy stocks, hold them long term, and you will retire rich. The American dream is just one index fund away. Except that is complete garbage. And the proof is everywhere if you are willing to look past the propaganda. The stock market is not a level playing field where your grandma competes equally with billion-dollar hedge funds. It is a wealth transfer machine designed to extract money from regular people and concentrate it in the hands of those who already have everything. Here is the truth they do not want you to know. The stock market was never designed to help you build wealth. It was designed to help companies raise money and to help rich people get richer by trading those company shares. Everything else, the retirement accounts, the index funds, the financial literacy classes, teaching workers to invest their paychecks, all of that came later as a way to channel your money into a system that primarily benefits the wealthy. And once you understand who the stock market actually serves, once you see how the game is rigged from the start, you will never look at your 401k the same way again. Let us start with the basics, because they will not teach you this in school. What actually is a stock? A stock is a share of ownership in a company. When a company decides to go public, it divides itself into millions of tiny pieces called shares and sells those shares to investors. If a company has 1 million shares and you own one share, you own 1/millionth of that company. Simple enough. The company gets money to grow. You get a piece of the company that you hope will be worth more in the future. That is the basic transaction. But here is what they do not tell you about how this works in practice. When a company goes public through something called an initial public offering or IPO, regular people do not get first access to those shares. The shares go to big institutional investors, investment banks, hedge funds, wealthy individuals. They get to buy in at the IPO price. Then when the stock starts trading publicly and the price goes up on the first day, those early investors make massive profits immediately. You get to buy in after the price has already jumped. The game is rigged from the very first transaction. Now, before we go deeper into how the stock market transfers wealth from regular people to the rich, if you are tired of financial advice that pretends everyone has equal access to wealth building, hit that subscribe button right now. This is Money Trap Channel, and we are exposing how the systems that claim to help you are actually designed to extract wealth from working people. We show you how money actually flows in the economy instead of the fairy tales they teach to keep you invested in a rigged game. Subscribe, because what comes next will completely change how you think about your retirement account. So you understand that stocks are shares of companies. But how does the price of a stock actually get determined? This is where it gets interesting and where regular people start losing. Stock prices are set by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. Sounds simple and fair, right? Except that this system assumes all participants have equal information and equal ability to trade. And that is absolutely not true. Big institutional investors have access to information you will never see. They have teams of analysts studying companies full-time. They have relationships with company executives who give them insights before public announcements. They have algorithms that execute trades in milliseconds based on news and data. Some of them engage in practices that would be illegal for regular people, but are somehow allowed for institutions. High-frequency trading firms can see your order before it executes and trade ahead of you to profit from the price movement your order will cause. This is legal. They call it providing liquidity. It is legalized front-running. But let us say you decide to invest anyway. You open a brokerage account. You buy some shares of a company you believe in. You are told to hold those shares for the long term. Do not try to time the market. Do not panic sell when prices drop. Just buy and hold and let compound interest work its magic over decades. This is the advice every financial advisor gives. And it is true that this strategy can work. The stock market has gone up over time. If you invest consistently and hold for 30 or 40 years, you will likely have more money than you started with. But here is what they do not mention about this strategy. While you are holding your stocks through every crash and recovery, the wealthy are doing something completely different. They are actively trading. They are using options and derivatives to profit from volatility. They are shorting stocks to make money when prices fall. They are buying when everyone is panicking and selling when everyone is euphoric. They have the capital to weather downturns and the information to know when to move. You are told to buy and hold no matter what. They are told to be strategic and active. Your strategy makes you a passive provider of capital. Their strategy makes them active profit takers. And this brings us to one of the biggest lies in finance. The idea that the stock market is disconnected from the real economy. You hear this all the time. The stock market hits new highs while unemployment is up and wages are stagnant. And the explanation is always that the market is forward-looking. It is pricing in future growth. It is anticipating recovery. But here's what is actually happening. The stock market reflects the wealth and power of shareholders, not the health of the economy. When a company announces layoffs, its stock price often goes up. Why? Because layoffs cut costs and increase short-term profits. Shareholders benefit from workers losing their jobs. This is the system you are investing in. Let us talk about what moves stock prices, because this is where regular investors get destroyed. The official story is that stock prices reflect the fundamental value of companies. If a company is profitable and growing, its stock price should go up. If a company is struggling, its stock price should go down. And over the very long term, this can be true. But in the short and medium term, stock prices are driven by narratives and sentiment more than fundamentals. A company can have great earnings, and its stock can fall because investors expected even better earnings. A company can lose money every quarter, and its stock can soar because investors believe it will be profitable someday. This creates a casino-like environment where regular investors are constantly guessing about what stories will be popular next quarter. Meanwhile, professional investors and insiders are trading based on actual information about what companies are doing. They know about deals before they are announced. They know about problems before they become public. They have analysts who spend all day studying one industry while you are trying to research companies in your spare time after work. The information asymmetry is massive, and it is designed this way. Here is something else they do not tell you. When you buy a stock, you are not buying it from the company. You are buying it from another investor who is selling. Every transaction has a buyer and a seller. When you buy because you think the price will go up, someone else is selling because they think the price will go down, or they have information you do not have. This is a zero-sum game at the transaction level. Your gain is someone else's loss. And the people with more information and resources win more often than the people without. Now let us talk about the biggest scam in the stock market. The idea that it rewards long-term value creation. Companies are told that if they build great products, treat employees well, and invest in the future, their stock price will reflect that value. But here is what actually happens. Companies are judged quarterly. Every 3 months, they have to report earnings. If those earnings do not meet expectations, the stock gets punished. This creates enormous pressure to maximize short-term profits at the expense of everything else. CEOs cut research and development to boost quarterly earnings. They lay off workers to reduce costs. They buy back their own shares to artificially inflate the stock price instead of investing in growth. Why? Because CEO pay is tied to stock price. When the stock goes up, executives make millions or even hundreds of millions in stock compensation. They have massive incentive to pump the stock price in the short term, even if it hurts the company long term. And who suffers? Workers lose jobs. Customers get worse products. The economy loses innovation. But shareholders and executives make money. And you are told to keep buying and holding because it is good for your retirement. Let us talk about index funds, because this is where most regular investors put their money now. An index fund owns a little bit of every company in an index, like the S&P 500. You buy the index fund and you get instant diversification across 500 large companies. This is supposed to be the safe, smart way to invest. Just buy the whole market and hold forever. And yes, this strategy has worked historically. The S&P 500 has returned about 10% per year on average over very long time periods. But here's what they do not tell you about index funds. When everyone invests in index funds, it creates weird distortions in the market. Companies get money from investors, not because those investors analyzed the company and decided it was good. They get money because they happen to be in the index. Bad companies in the S&P 500 get investment dollars. Good companies, not in the index, get ignored. This disconnects stock prices from fundamentals even more. And it concentrates even more power in the hands of the few companies that manage the biggest index funds. 3 companies, BlackRock, Vanguard, and State Street, control about 20% of the shares of most large American companies through index funds. They are the biggest shareholders in almost every major corporation. They have enormous power over corporate decisions. And they are managing your retirement money. You own the index fund. They vote the shares. They decide what happens with that corporate power. You are giving them control over companies while taking all the investment risk yourself. Here is another thing they do not tell you. The stock market is not a place where regular people build wealth. It is a place where regular people store wealth that corporations and executives extract. Think about what happens with your 401k contributions. Every paycheck, money gets taken from your wage and invested in the market. That money flows to corporations who use it to buy back their own shares and pay executive bonuses. The executives sell those shares to take profits. The money flows from your paycheck to executive pockets. And you are left holding shares hoping they will be worth more someday. But here's the problem. That someday is usually retirement, which means you need to sell those shares to someone else to actually use the money. And who is going to be buying? The next generation of workers putting money into their 401 kiloseconds. This is a perpetual motion machine, where each generation of workers buys stocks from the previous generation, while executives extract wealth at every stage. And it only works as long as new workers keep contributing. If that flow stops, the whole system collapses. Let us talk about market crashes, because this is where the wealth transfer becomes obvious. Every decade or so, the market crashes. Stocks lose 30, 40, 50% of their value. Regular investors panic and sell at the bottom, locking in losses. Then the wealthy, who have cash on hand, buy at the bottom. The market recovers. Prices go back up. The wealthy who bought at the bottom make enormous gains. Regular investors who sold in panic bought back in higher or never came back at all. Every crash is a massive transfer of wealth from regular people to the rich. And here's what makes this especially insidious. The crashes are often caused by the exact same wealthy investors who profit from them. The 2008 financial crisis was caused by banks making risky bets and creating fraudulent mortgage securities. The market crashed. Regular people lost their homes and their retirement accounts. The banks got bailed out with taxpayer money. The executives who caused the crisis kept their bonuses. And wealthy investors bought assets at the bottom. The people who caused the crash profited from it. The people who did nothing wrong lost everything. Think about what you are told about these crashes. They are natural corrections. They are part of the market cycle. You should not try to time them. Just keep buying and holding through the volatility. This advice keeps your money in the market where it can be harvested. Meanwhile, insiders and institutional investors are moving in and out based on information and strategies you do not have access to. They are selling before the crash and buying before the recovery. You are holding through the whole painful cycle. Now let us talk about dividends, because this is supposed to be how you actually get paid as a shareholder. Some companies pay dividends, which are cash payments to shareholders from company profits. You own the share. You get a small payment every quarter. This is supposed to be your reward for being a long-term investor. But here is what actually happens with dividends. Most growth companies do not pay dividends. They reinvest profits to grow. So if you want dividend income, you have to buy boring, mature companies that are not growing much. And the dividends you receive are taxed as income, while the wealthy are getting their returns through stock appreciation, taxed at lower capital gains rates. But even worse, companies increasingly do not pay dividends at all. They do stock buybacks instead. They use profits to buy back their own shares from the market. This reduces the number of shares outstanding, which mathematically increases the value of remaining shares. But here is who benefits most from buybacks: executives with stock options. When the company buys back shares, the stock price goes up, and executives can sell their options for profit. Regular shareholders get a small boost in their share price. Executives get millions in compensation. The company could have invested that money in growth or paid workers more. Instead, it went to pump the stock price for executive benefit. Here is something that will blow your mind. Over the past decade, S&P 500 companies have spent more than half of their profits on stock buybacks. Not on innovation, not on worker wages, not on building new products, on buying back their own stock to enrich executives and wealthy shareholders. This is what happens with your investment dollars. You are told you are investing in American business and innovation. Actually, you are funding a wealth extraction scheme. Let us talk about what happens when you actually try to sell your stocks. You are told to invest for retirement, which might be 30 or 40 years away. That is a very long time to have your money locked up. Yes, you can technically sell any time. But if you sell early, you face penalties on retirement accounts, and you pay taxes on gains. The system is designed to keep your money invested as long as possible. Meanwhile, the wealthy use margin accounts to borrow against their shares without selling. They get access to their wealth without triggering taxes. They can spend their money while you are told to keep yours locked up for decades. And here is the really disturbing part. The entire retirement system is built on the stock market now. Pensions are mostly gone. Companies got rid of them and replaced them with 401 kiloseconds, where you take all the risk. Social Security is not enough to live on. You are told your retirement depends on the stock market. This gives you no choice but to invest. You have to play a game that is designed to benefit others more than you. And you have to keep playing for your entire working life. This is not freedom. This is a trap. So what is the takeaway here? The stock market is not a fair wealth-building tool available equally to everyone. It is a system designed to transfer wealth from regular people to the wealthy and to corporations. The price movements you see are driven by information and power you do not have access to. The advice to buy and hold makes you a passive provider of capital, while others actively extract wealth. The retirement system forces you to participate in a rigged game. And every crash is an opportunity for the wealthy to harvest your losses and concentrate more wealth. Does this mean you should not invest at all? Not necessarily. The stock market does go up over very long time periods if you can hold through the crashes. And you likely need some exposure to stocks to have any chance at retirement given how the system is designed. But you should go in with your eyes open. You are not playing the same game as the wealthy. You are providing the capital they extract. You are the mark at the table. The sooner you understand that, the better decisions you can make about how much of your wealth to risk in the system. The stock market is not broken. It is working exactly as designed, to concentrate wealth. to give corporations access to cheap capital from workers, to create the illusion of shared prosperity while extracting value from regular people. The fact that some regular people build wealth through long-term investing does not change the fundamental nature of the system. It is a wealth transfer machine wrapped in the mythology of the American dream. And until more people understand that, the transfer will continue. Thanks for sticking with us through this. Make sure you check out the next video that is about to pop up on your screen. We are diving even deeper into the financial systems designed to extract wealth from regular people while pretending to help them. This is Money Trap Channel, and we will see you in the next one.